This is the current federal tax developments brought to you this week by Kaplan Professional Education and your state society of CPAs. This week, we're going to look at a few developments that have come up. We've got a couple of issues from the IRS. First, the IRS announced that they are going to be able to begin to process some returns that have provisions that were retroactively restored for 2017 by the Bipartisan Budget Act. The IRS also reminds taxpayers about what will qualify for deductible mortgage debt in 2018, including the fact that the mere fact that something is labeled home equity debt on the, on that loan document you've got, or on the, it told us a home equity line of credit, will not necessarily mean it's not deductible. The AICPA this week was busy. They sent a couple of letters out. The one we're going to look at this week is going to be related to a letter outlining some areas of guidance under Section 199 Cap A, the Qualified Business Income Rules. We'll talk about some of the guidance that we need to have, issues we need to have guidance on right away. The taxpayer, in a case we'll look at, ended up managing to foul up how you divide an IRA in a divorce and ended up with a tax bill because of it. And in the final case, we have the IRS losing in their attempt to force a taxpayer to treat a gain on sale of land as ordinary income. Let's start with the first issue this week. That is that the IRS announced that they are now going to be able to start processing returns that have some of the provisions that were added back into law by the Bipartisan Budget Act. The Bipartisan Budget Act, which was passed into law on February the 9th, ended up restoring a number of provisions that had expired at the end of 2016, having them carried on for one more year into 2017. The provisions involved were a number, but the three that the IRS now can process returns that have these issues on them include the following. If you have a return that has the home mortgage debt cancellation, somebody had a canceled debt, was secured by their home, it happened in 2017, that particular exclusion under 108 is back. So you can go ahead and process a return that has a Form 982 that processes based on cancellation of debt not being taxable because it was secured by their home. The deduction for home mortgage insurance premiums also is being restored. I have seen some reports already that some people now are receiving amended Form 1098s that now list the home mortgage insurance premium on the 1098. A lot of them I had seen before this law got passed had been issued, and if they had the mortgage insurance premium on them, that was put out as an informational edition. Now, apparently, some of them are going back and reissuing the 1098s, showing the mortgage interest on there. So don't be surprised if you get some of that from clients now in the mail. You get a new 1098. Finally, we get a restoration of the deduction for qualified tuition and related expenses, that above the line deduction that we could take that was not on this year's return initially because Congress had not extended it past the end of 2016, but it now is back. These aren't everything that were added back by the Bipartisan Budget Act, but they're some of the more significant ones. And the IRS announced this week on February the 22nd, in News Release IR 2018-33, that they are now able to process electronically filed returns that have these items on them. Important thing to note is they still are not ready to process returns that have things like certain energy credits on them. So a lot of the credits that got extended, remember we had a bunch of energy related credits that had died at the end of 2016. They got resurrected for one more year through 2017. They're not yet ready to process those returns. So it doesn't solve everything. The other issue that we have, of course, is that our tax software still has to be updated for the most part. Even when the IRS gets ready, then the tax software has to be updated to handle these issues. Most of the vendors probably will get the updates. If they're not out now, they will be out by the end of the week. But nevertheless, it's one of those things you have to keep your eye on for updates. And remembering your software is going to have to be updated to process this stuff so the IRS can accept it. So watch for those updates. That'll be coming. Some people may be tempted to say, well, the return's done. The only thing we're missing is this one thing. The IRS isn't ready to process it yet. Why don't we file the return now and then we'll just amend the return and go ahead and get the refund for that adjustment later? The IRS does remind people that, well, if you've already filed returns, your only option is to amend them. But here's the catch with the amendments. The IRS in this news release tells us that they expect it will take up to 16 weeks to process an amended return looking for a refund under these provisions. That means that, your client says, well, why don't we do that right now? So I get this much today, and then we'll do the amended return and, a week later. And they're thinking, well, that'll be a week after I get my first refund, I would get the second refund. You got to remind clients that, no, if we go ahead and process now, it's going to be sometime probably in the summer when you will get your refund that you're looking for the rest of the refund that comes from these BBA provisions. So it's one of those discussions. I realize people get antsy. People want to go ahead and file. People want to take care of stuff right away. But the issue becomes, remember that until the IRS is ready to process these things, if you file, then amend, it's going to be very long wait for getting that refund check back. The IRS gave us another news release this week. This is news release IR 2018-32. This one came out on the 21st of February. And this discusses what's been, I think, for a lot of people, confusion we have seen around the provision in the Bipartisan Budget Act regarding what will be deductible mortgage interest next year. The key issue this thing is pointing out is the fact that a loan is called a home equity loan in your documentation. It was a home equity line of credit. It was whatever we call this home equity, home improvement loan, but it was something that you're thinking, well, they call this a home equity loan. It was based on my equity in my house. That is going to be non-deductible. Not necessarily so. This is one of those issues where Congress, unfortunately, defines a term very technically, but they're defining a term technically that is, in fact, used generally by people in a way that is different from the way the Congress defined it in the code. So, as a practical matter, the thing to remember is any debt that meets the requirements of acquisition debt is deductible regardless of what it is called. Okay, regardless of what it is called. I've gotten more and more questions from people when I've done courses, when I've been in discussions, when I've been in news groups, where there's been this long discussion of, but a home equity line of credit's not deductible. And it's like, no, that's not what the law says. Well, a second mortgage is not deductible. No, that's not what the law says. Right. What the law says is what is deductible. What is deductible is any debt that meets these two requirements and that doesn't go over the $750,000 limitation, or if grandfathered the million, is going to be creating deductible interest. The two tests are: number one, the debt must be secured by one of the taxpayer's two residences. Remember, we can only use two residences for the purposes of the home mortgage deduction. It is still two. So we've got to secure it by one of our two residences, and that debt must have been used to acquire, construct, or substantially improve that particular residence. Please note that other caveat there, that particular residence. If both of those are true, we do not care what the loan is called. And if both of those are not true, we also don't care what the loan is called. A first mortgage that arises from a refinancing, where you take out, let's say, not just a refinance, let's say the home's paid off. And now I go out and I get a brand new mortgage. It's in the first in line. It is for the value, it's for 80% of the value of my home. That may be a first mortgage, but it's not going to create any deductible interest unless I use it to substantially improve my home. Now, where the confusion comes is that there is a reference in Code Section 163H3C to something called home equity debt. And not Bipartisan Budget Act, that was the other act. The Tax Cuts and Jobs Act specifically says home equity debt's not deductible. But that's home equity debt as defined by the code. The code's definition of home equity debt is basically debt that meets the security requirement we just mentioned, but fails to meet the use for constructing, substantially improving. It meets one but not the other test. So that's what's called home equity debt. It doesn't matter. If you have a home equity line of credit, your client has a home equity line of credit, they took a check for $50,000 from that, and they used that to substantially improve the home, that debt's going to be deductible. It doesn't matter what other things may come up. Now, as part of this, the IRS actually gave 3 specific examples about, what counts as mortgage interest under the TCJA rules for 2018. And you might want to take a look at those. They're kind of useful. One of the good examples there is the example I kind of alluded to, where a taxpayer maybe, is almost fully paid off their home. And so they've got $500,000 of equity in it. They decide to borrow, they go to the bank, they want to get a vacation home somewhere. The bank says, well, we could go the whole process of getting you qualified on that home in the vacation location. Or, you know what, that vacation cabin you're looking at buying is going to be about 200 grand. We could just give you a 200 grand loan on your current residence. Well, if you do that, yes, the vacation home could be the second home. So there, 1, 2, we've got them. But if you secure the loan by your main residence, but use it to acquire the second residence, then that's just plain old personal debt, personal interest. And that personal interest is non-deductible. Again, remember, 2 tests: secured by the home and used to acquire or substantially improve the home that is the security for the debt. Meet those 2 requirements, you've got deductible mortgage interest in 2018. Fail either one of those, you don't. Now let's go on to the AICPA. Had a busy week, and in addition to sending a letter to Congress regarding what the AICPA sees as significant technical corrections needed in the Tax Cuts and Jobs Act, the AICPA also sent a letter to the U.S. Treasury and the IRS, specifically outlining what the AICPA sees as clarifications needed under the 199 Cap A rules. Those are the qualified business income, that 20% deduction. There are certain areas the AICPA felt needed immediate guidance, and then areas that need guidance, but it's not quite the hair on fire concept that we have with the 6 that they really think we need to have guidance on immediately. And I use the hair on fire analogy because that was actually an analogy I saw this week in a email tax broadcast that went out, one of Politico's morning, tax briefings, which actually is a pretty good place to find some details about things going on, at least at the highest levels. We talk about it when Congress is doing something or when Treasury is working on something. It's kind of a useful thing to get a little flyer about what's happening. And there they had quoted somebody regarding these 6, these particular guidance areas, noting that in 199 Cap A, for those of us trying to, help clients set up organizations or set up businesses, these are kind of hair on fire moments because we need a decision now and we don't know how it works. Well, the 6 areas that the AICPA suggested we needed some immediate guidance on. And by the way, they have details under each one of these, and you can get the letter. It is linked to in the PDF that we have every week with the information regarding these particular developments. So if you go to that link, or you just go to the AICPA's website, you can search for it. Probably best to search for it on Google. You search for an AICPA letter on 199 Cap A guidance, and you'll probably get it. You want to know the definition of what is qualified business income. That includes some clarifications on what's a specified service business, and all those other neat things we have to worry about. Can we aggregate businesses? How do we determine what is a trade or business? Is it okay, is it okay to, like, inside an entity have 3 trades and businesses, or have a trade or business that maybe is 2 entities that we've got? Are there ways to aggregate? Can we do things like we do for passive activity rules under 469? Can we do that? What's the deductible amount of qualified business income for a pass-through entity that has a business net loss? And how does it interact with the carryover provisions and all of those things? What kind of wages qualify, for the deduction, for that limitation, especially like wages paid by an employee leasing company? That's not necessarily clear per the law as written. We want to know, how does 199 Cap A apply if you're a fiscal year pass-through entity? That is a real interesting question, because back in the day when they came up with 199, just plain old section 199, which was the section that we had was, our deduction for the domestic production deduction, kind of, where they borrowed this whole W-2 aspect from. that actually did tell us that, how we handled a fiscal year. That was part of the bill. Wasn't codified, but it was part of the bill. Now the problem is that we have no such guidance today. So with a fiscal year, let's say you have a fiscal year S corporation that qualified or is, doing the permitted fiscal year. So they're there, they paid the money in, so they've got the deposit going. So they're going to have a September 30, 2018 fiscal year. Does that pass anything out that's 199 Cap A? Not really clear whether it does or doesn't. And, exactly how does this work? And is this deduction available for electing small business trust, ESBTs? That's also a clarification that's needed. In addition to those 6 issues, they have 23 others that they're coming down on in various areas that talk about, how in the world do we handle these things? You want to go take a look at that letter. I think it's really useful letter, if for no other reason, then it tells you the areas that when you're trying to work with a client right now, where maybe there are things that you might not have yet noticed, but others looking at it have decided this might not be totally clear. And that'll help you at least warn the clients. Obviously, here's the problem. We need to set up a business today, and we're going to make some decisions, but at least try to figure out where the potential bombs are and, where we could end up with a problem. We're going to step on a landmine by doing something that we thought that's how the law would work, but it's not, trying to do it. As I tell clients right now, we're trying to maintain as much flexibility as possible. That may not get us the optimum result at the end of the year, because maybe it would have been the best thing in the world to, let's say, have been a C Corp and use the 21% rate instead of trying to use this, qualified business income deduction. But you know what? If we decide to go C Corp and then find out the qualified business income deduction really was totally available to us and would have been great, that's tougher to get back from. So again, we're trying to build our flexibility as best we can. Also, you should understand this is just the first of what's likely to be a series of letters from the AICPA to the various people in Treasury about what's going on, what areas need guidance. If you're not aware of how this works inside the AICPA, there are a number of volunteer, and I want to emphasize these people are CPAs who are right now during tax season taking time out to look at this law and come up with this guidance and come up with these questions. These are volunteers on the task force, most of whom are from small, local, non-big four, non-national CPA firms. It's also important to understand. So there are a lot of people, of that, the people generally, because remember, over half of the people who are practicing in public accounting are in small, who are pro-tax or in tax practice are in small firms. That's just the nature of it. And that's who really makes up most of a lot of these committees. These people are putting together what they see as the things we need as guidance. And they do a very good job, but obviously they're under a lot of time pressure. This is not a whole bunch of people paid, sitting there twiddling their thumbs, writing this up. This is a lot of people trying to juggle tax season and this together. We expect we're going to see other comments come down the line, so be aware of that. Well, let's go on to a couple of cases now, getting out of all this stuff about the law changes and how we're having to deal with them. Let's talk about some cases, good old case law, the stuff we dealt with before we had all the law changes. And the first one we're going to look at this week is a case of Kirkpatrick, versus Commissioner. Tax Court Memorandum Decision 2018, number 20. This one came out on February the 22nd. And this case deals with a divorcing couple and an IRA. In this case, Mr. Kirkpatrick had an IRA as part of the divorce, and we're told it wasn't a terribly amicable divorce, shall we say. It's kind of how the court referred to it. It was somewhat, shall we say, difficult. But they eventually decided that a portion of Mr. Kirkpatrick's IRA, $100,000, was to be transferred to his wife tax-free, and he was to pay $40,000 of legal fees. These are at least the two relevant things we need to worry about here. So it was a court order. And what the order said that he should transfer to his soon-to-be ex-spouse the sum of $100,000 directly and in a non-taxable transaction into an IRA appropriately titled in her name within 14 days of the order. Well, a couple things happened. Well, the taxpayer didn't really follow the order. First thing is he transferred nothing within the 14 days. And then secondly, what he did was he took funds from the IRA and he just started transferring them to his soon-to-be former spouse. Now, he took a lot of money out of the IRA for various things during the year, but specifically, he claimed that $140,000 of what he took out was not to be considered taxable. And he based that on the rules that we're going to find here on Section 408D6. 408D6 deals with dividing an IRA in a divorce. Now, important thing to understand here. If we're talking about a qualified retirement plan balance, that's where we have to worry about the qualified domestic relations order rules and all of those special things that have to be done properly to make this work. An IRA does not technically come under the quadro rules. Rather, 408D6 has a different structure. You do not need a quadro to divide an IRA, but you do have to have under D6, essentially, you have to basically transfer the IRA to the non-owning spouse, and it has to be done in accordance with basically a divorce or separation instrument that meets the requirements that would be generally required for one that would be an alimony, that would also allow you to set up alimony. So this order qualified for that. It was a qualified order. This order, specifically stated to him, it didn't say directly, you want to do this under 408D6, but clearly the implication was that, you're to divide this and make it tax-free, and 408D6 allowed a tax-free transfer into an IRA of the spouse. But that's not what he did. He just took the money out. Now he said, well, I meet those requirements, right? Because I was told to transfer the money out. There's the order, do it from the IRA. So I have to pay tax on the $100,000. Well, here's the problem. Number of cases, the court points out, you cannot ever take the funds out of the IRA under a 408D6 transfer. As the court noted, even if, which the court did not find, that $100,000 had somehow made its way into the account of the soon-to-be ex-spouse, an IRA account, that still wouldn't be valid. In fact, what would happen in that case is the soon-to-be ex-spouse would have almost certainly a rather drastic over-contribution to the IRA account, assuming we don't have some odd situation like she qualifies to set up a SEP account, and it could be a SEP IRA contribution. And again, at $100,000, that's going to be a little tough. But basically, she would be over-contributed. But the court didn't find any of that happen. Rather, most likely, the money just got spent. The court also made it clear that the $40,000 for legal fees being paid to her, that clearly was never to be transferred to an IRA, so that couldn't qualify. But once you take the funds out of the IRA, you're no longer transferring an interest in an IRA, you're transferring cash. So it doesn't qualify. So because of that, the distributions in this case were held to be fully taxable to the taxpayer. Now, here's the interesting part. He clearly could have done this properly. It wouldn't have been that difficult. It's not that difficult to step through. Most financial institutions understand these rules, and most of them will work with you to get it done. What he should have done was basically the normal way is, as the court outlines here, in this case, because she wasn't going to get the whole IRA, normally what he would do is he would have her set up an IRA in her name, and then there would be a direct transfer to that IRA from his custodian to her custodian for $100,000. The alternative would have been for him to split his IRA into two pieces, one of which had $100,000 in it, one of which didn't, and then simply retitle his IRA with $100,000 into her name. Either one of those would have accomplished the goal and would have transferred the funds tax-free. And then if she decided she needed the money to do whatever she needed the money to do, it would have been taxable to her. Under this scenario, ladies and gentlemen, it's taxable to the owner of the IRA account. So be careful not to foul that up. Finally, we have a case on a topic that's come up multiple times and you run into all kinds of clients. This is Sugarland Ranch Development, LLC versus Commissioner, Tax Court Memorandum Decision 2018-21, issued on February the 22nd. This involved a partnership that was formed back in 1998. And it acquired land in Sugar Land, Texas. Sugar Land is just outside of Houston. And it acquired land that it planned to develop. Now, catch was, things didn't move too quickly there. And eventually, a decade later, 2008, you may remember the real estate market kind of crashed hard around 2008. And the partners in this partnership basically decided that development was no longer feasible. They hadn't really gotten very far going on it. Development was no longer feasible. So they were just going to keep holding this land, as a lot of people decided in 2008. We're going to keep holding this property until values come back up and it's reasonable to sell it. They stopped all development activity, did nothing. They even adopted a unanimous agreement, actually documented this, which is really neat, that a client would go this far and do it. But they did in the LLC, that their plans had now changed and they were going to be holding the property for appreciation. In 2012, a buyer approached them. They did not approach a buyer. A buyer came to them who was interested in acquiring the land. A portion of the land. That portion of the land was sold to this buyer. The rest of the land they were holding ended up being transferred to related parties, and we won't worry too much about those transfers. The sale of the land in 2012 to this third-party buyer was the key. They recorded that as a capital gain. The IRS came back in and examined the partnership and said, oh, no. We think this is actually ordinary income asset. Now, the key comes, how do we make this decision? Under Section 1221 defines what's a capital asset. For those of you who are not aware, a capital asset is essentially any asset that the taxpayer holds that is not specifically excluded from the definition of capital assets. But 1221A1 provides the following as an exclusion. Any stock in trade of the taxpayer, other property of a kind, which would probably be includable in the inventory of the taxpayer if on hand at the close of the taxable year, or property held by the taxpayer primarily for sale to customers in the ordinary course of his trade or business. The IRS says, well, this land was that. You acquired it to develop it, to make it into lots for residential lots and make it into commercial lots and sell it off. So that was your trade or business. Well, the court said, we're not so sure that works. They noted this appeal would go to the Fifth Circuit Court of Appeals. In the Fifth Circuit, their standard for testing whether it gains capital or not in a case like this involves three questions. Was the taxpayer engaged in a trade or business, and if so, what business? Was the taxpayer holding the property primarily for sale in that business, and were the sales contemplated by the taxpayer ordinary in the course of that business? The tax court found that, in fact, there was no development business being conducted at this time. They were not holding the property primarily for sale for development business, and this wasn't an ordinary developmental sale. Remember, the party approached them and acquired the entire asset from them. The court did not accept the IRS's view that it should be ordinary income simply because that's what it would have been had they done what they intended to do with the land back in 1998 when they acquired it. The court made it very clear that a taxpayer could change their mind. Now, that's all well and good. And yes, the taxpayer, the IRS in the end loses. The court finds it's not inventory and this is capital gain. But it's also a caution to remember. It's really interesting to me the service even brought this case because these people had, been holding the land for an extreme period of time from 1998 to 2012, had never really done any serious development work. In 2008, had clearly indicated they were changing to just holding, and they dropped all the development plans. And then in 2012, a third party approached them and bought the land, an unrelated third party. It's like if there ever was a fact pattern that indicated that their intended use had changed, this would be it. But what it does indicate to us is, and clients need to understand, yes, you can change your mind, and yes, that is defensible. But you may have a difficult time, convincing the agent. I can't tell you that I'm just going to walk in, tell the agent, see, they changed their mind. The agent will suddenly have this moment of just, oh, yeah, that's right. And the exam's going to stop. Obviously, in this case, Sugar Land Ranch Developments had to go all the way to the tax court and spend the money to go all the way to the tax court to be able to defend their capital gain. Did it make sense with the numbers in this case? Almost certainly it did. But there's the warning is, remember, this case got all the way here, And the mere fact it got here is a little bit disconcerting. Well, it is tax time. Hopefully you're all nice and busy and you're down there working on all of your tax, all the tax returns the clients now have brought to you. Please remember your state societies are still out there doing work and working with you. A lot of them now are working on conformity legislation in various states' legislatures and trying to get some input on that. We're also working on some courses that we'll be bringing up after tax season. There's still going to be a lot of Tax Cuts and Jobs Act guidance to talk about after tax season. We just barely had time to kind of get into it before we had to all get into tax season mode. And right now I've already got booked 4 different sessions. We'll be announcing them later as the various societies are ready to announce them. We've already got 4 different sessions just in May that are going to deal with some form of the Tax Cuts and Jobs Act. So lots of things happening will be out there. So remember, once you finish tax season, your state societies have guidance. And yeah, you probably want to try to get guidance as soon as you can regarding all the fun stuff with the Tax Cuts and Jobs Act. Because, hey, once tax season is over, people are going to be forming entities. You kind of need to know how things are working. This has been the current federal tax developments again for the week of February 26th. I'm Ed Zollers, and I always bring this thing to you here on the weekly basis. You can catch our updates, and we post them on the web at currentfederaltaxdevelopments.com. Been posting there for whatever reason. We've been getting them in kind of just spurts during the week, and then not much happening otherwise. So it's been kind of interesting. If you have any questions or comments about anything you've heard on here or seen on here, you can email me, Ed Zollers at currentfederaltaxdevelopments.com. You can also follow me on Twitter. That'll be at Ed Zollers. There I post things. Normal things I post are when I post to the website, so there's a new article up. But also from time to time, if I get a hold of a document or see some interesting article, I'll also kind of post that up there. You can also follow discussions I participate in. I've got them on the subreddit of www.reddit.com/r/taxpros, the Tax Pros group in Reddit. Again, useful place to go. Certainly if you want to ask a question in the open and get a number of people to take a look at your issue, that's a nice place to post. Also do quite a bit on the Tax Talk discussion group for the California Society, quasi-California Society. Anybody in the country can join that. And also on Arizona Society's group, I'm in that group doing some work. So hang around various places. So certainly there are places you can contact me. We expect more things to be happening, guidance to be coming, a lot of TCJA stuff to be coming over the next few months. So be sure to join us next week when we'll take a look at, have we gotten anything in the interim then? And we'll talk about anything else that comes up in developments in the area of federal taxes.